Hey guys, welcome to this video. I'm doing a video on gold today because it's starting to move to the downside as we look short. Don't forget to get my free training underneath this video. Don't forget to like, share, comment, subscribe if you're watching somewhere else. And we are going to do a full rundown now. So let's go over things carefully. As you all know, if you've seen various gold analysis videos that I've done, there's some really key points you can take away from the historic price market. And you can see I'm highlighting them there. So I've spoken about this continually. We all know that this was an area of key price action, key rejection. We all know that's an area where buyers have said, okay, well, you know what? This is as far as I want it to go. I'm going to liquidate my long positions and effectively, therefore, I'm going to be getting short. Okay, and you can see that is exactly what has caused the fall each time. As soon as those long orders are liquidated, people are effectively short, therefore, and the market comes way down. Now, professional traders know this, institutional trading bodies know this, okay, and that's why you get it every time, or at least the last 3 times, as you've seen. Now, you'll notice if you zoom out, or you just put your time frames up, monthly, 12 monthly, you'll notice that the trajectory of gold has always been to the upside. So in the knowledge of that, and on this chart you can see, well, we can go back to the 60s, okay, 60 years or so, you can understand that you always seem to beat the high eventually. Okay, sometimes it takes you from, well, as you can see, you had a peak in 1980, it took you 28 years or so, 27, 28 years to get back to the same price. Okay, so that can happen. But nonetheless, every single time forever, you've had a growing price in gold. So we know it's likely, based on all that data, okay, based on facts and what we can see, that ultimately this will break. Now, a lot of the time when I'm trading other assets, I say continually, the more and more times you hit on these areas, okay, eventually they aren't going to hold, okay, and that is just how things go. All right, so you may find that on your 4th push here, it may go through. But the difference between people who make money trading and who don't make money trading is very easy to understand. The people who lose their money are the ones who are saying, I'm going to buy if we break out, okay, if we break above the high. And the people who make the money are the ones who are sitting on the other side, who, like I said, are professionals, institutions, the ones making all the money, in other words. They are taking the opposite view. And time again, people say to me, why aren't you buying the highs? And the answer is extremely simple. It's not hard and it's not rocket science, okay? If you come off your computer now and you go out, you need a new car, would you prefer to buy it at an extremely high price? The answer is basically always going to be no. No one wants to do that. Yet, when you trade gold, you're getting long at the top. How does that make any sense? Okay, it does not, because people inherently sell things when they are high priced and they buy things when they're low priced. Hence the saying, buy low, sell high. If you're buying on a breakout, you're buying a high price. Naturally, you are buying into what is a high price. And like I said, yes, inevitably, I believe the price will go above. But if you traded that way, you've lost money time and time and time again. You've lost money every single time, yet you're going to buy again at that place. So don't be one of those people. That does not work. Buy low, sell high. That's how you make money trading, or trading anything. Like I said, if it wasn't your business, what do antique dealers do? They buy things for less, they sell them for more. What do supermarkets do? Buy things for less, sell them for more. They don't wait until the antique until the grandfather clock is $20,000 and then buy it. They buy it for 16 and sell it for 20. Okay, so down here is your 16, there is your 20. All right, so just remember that is the core market rule that we're going off at all times. We're buying low and we're selling high. So where does that leave us now? Well, I said you would really want to start to look short as you come up to this area. I actually said to liquidate early and re-short above this candle wick. Many of you, I'm sure, followed me and did that. My Academy members, I know, did that. One of which who was talking to me yesterday. I said, just hang on a minute. It can sometimes take time. And you've seen that drip down now, okay? And you're coming towards that 1965 level. And the reason why I said I would prefer to short above the highs because you really didn't see much weight fall from this area, okay? You didn't see a lot come from this. And the reason why is exactly what we're about to talk about in a minute. Is because of this really early price rejection. Now that is really significant as a point to understand because it's going to help us understand really what we would be looking for in the future. Now, the way I'm going to display that is by looking at the previous falls. Okay, now the reason why I'm doing this as well is because it gives you, like I said, a really good idea of why prices don't always plummet straight away. Okay, so you can see it actually with this fall from here, this fall in the middle of the other two. You can see that you only come as far as where I'm drawing. That is 1890 from a really, really sharp peak, almost an all-time high of 2071. Now the price stops where I've drawn these red arrows, okay? We'll get rid of the top one. The price stops around here. Now, why does it stop so early? If it was such a great short, why does that happen? Well, number one, you've got a fall of 2070 to 1890. Okay, so almost $200 in a straight drop. But more importantly, you have got this, okay, and you've got this, and all these levels within that eclipse I just drew need to be broken. Initially, you may find the price bounces at the first point, but there's very early support, and just like going through to the upside, okay, if you were to continue to the upside like this, in the same way, you've got to break the support to the downside. Okay, so that is why you end up getting these candle wicks. That's why you end up getting these bounces. And you can see that repeats again and again and again throughout history as time goes on. You see minor areas of rejection in the same place. So it gives you an idea where people are pulling their orders in and out of the market. Now, why is that important? Well, that is really important because what's happening now is that candle is falling back to where this candle ended. And that candle where with this red arrow here, this one right there, I have drawn that in line with what was key levels of support. In other words, where you can see all this price rejection. And like I said, it's no shocker, it's no surprise. Those levels have to be broken. And what's happening now is you're pulling underneath those levels that you've hit because they've been tried once, the price comes up, and then you can see that after that, it starts to fall back into these levels. So to look at that in a little bit more detail, you can see that's what's going on your daily. You're coming towards a very early 20 MA, and it's in line with these levels now of key support, key price rejection on your daily. And it's underneath this candle wick that we were just talking about, or that area. So what's happening now is the market is saying, okay, well, we're still falling. There isn't an enormous amount of selling power to push this down currently. So therefore, we can surmise that we're going to have to break that level of support. And if you look to the left, you can see there's various times where this occurs. Okay, so it's a very contentious level, and that's why you're not slamming through it. So if you are someone who's holding gold for things, you're going to have to be comfortable with breaking the levels like the one we're at, and then doing the same thing lower down. And that's why you really need to refer to higher time frames, because they block out all that amalgamation of price rejection and noise that is saying to you, wow, there's a lot going on here, and that's why we need to break it down slowly. So that is why you're drip feeding, if you like. But nonetheless, I mean, if you had it short, it's ideal time to lock in gains because that early support, which you can view on your weekly, for example, you may find it still remains contentious and you get slightly lower, but maybe you bounce. So locking in those gains is going to prevent you from risking not taking your profits that you have got on the table. Now, on the other side is, okay, well, if we come to early support, would you buy? Now, we were long down here, as many of you know, and it crossed over with an amazing technical zone, great tech zone, tons of price action levels to the left. Okay, we had a very high, well, we have a high hit rate normally because we're looking for an increase in probability all the time. That's what makes people, well, people like myself, traders. But you had that long move. You traded on fact. You said, okay, well, there's rejection at this point. A 200 MA is likely to display to people that the price is low on a high moving average, the 200. Okay, so 200 candles is the lowest point. Just like if you're looking at the web or anything else. And that's what gave you that boost. It's what gave you that push. But it doesn't always last forever. That's why you don't buy at the end of it. You buy at the start of it. You are buying low to get the impending up move. Okay? So just be fully clear and fully aware of that. I would ideally be out of those shorts. I think you're going to have to break several levels lower. And I would only look long if you can fall much lower. Okay, I'd really have to see this get whacked at least 1935 and under. And ultimately, if you do find tensions ease across the world, I know they're raising, you may find yourself much lower, back to levels of $1,700 or underneath as the market recovers. But long term, you know you're breaking every high. You know there's a chance you can break this high, but you don't need to say, okay, well, I've seen it 3 times and I'm going to go crazy. I'm going to sell everything. You know, if the price returns up here, don't be one of those people. You can trade it lightly, perhaps. Okay, and you can understand that eventually it will break, but it's not your job to guess when it will break. Your job is to get market value at what is true. And you can see what is true by looking back on your charts where people have previously liquidated those long orders and flipped to the short side accordingly. So I hope that helps. Full rundown on gold there. Don't forget to get my free training underneath. Like, share, comment, subscribe, and of course, I will see you as always in the next video. See you there, guys.